Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, Portfolio Analyst and CFA Level 2 candidate. Thank you, Zach, for coming on and covering for Andrew. This week, we got 4 topics for you. We're going to talk about consumer spending and the shifts there. Then we're going to go back to the labor markets, touch up on commercial real estate, and look at really a rapidly evolving market there, particularly as a lot of appraisals and marks get done here in the first quarter. And then lastly, we're going to take a look at the threat of AI, in particular, look at a historical example of spreadsheets. But for starters, Zach, you brought this to our attention to cover this Monday, so we'll have you go ahead and tee it up today and share with us what's developing in the consumer spending sector.
Yeah, so over the past year or so, despite rising inflation, spending has actually remained relatively strong, in large part driven by wage growth and a strong labor market, a lot of demand for labor. So as people are continuing to make more money, they're continuing to spend more money, which has kept consumer spending high. Last week, though, we got some updated data, and it's the far right set of bars over there. And you can see that it actually slowed down a bit, quite a bit. On an inflation-adjusted rate, it actually declined slightly. So what that tells us is that there's the potential, because consumer spending is such a big driver in the U.S. economy, there's the potential that if we start to see maybe a weakening labor market, that could significantly impact consumer spending. Consumer spending continues to taper off, like we saw last month. That could mark a turning point in terms of the strength of the economy. It feels like we have been 6 months from a recession for 18 months now. And so consumer spending starting to lighten up here a little bit could be an indicator that recession may be on our doorstep. However, we have seen the steam engine of the U.S. economy slow down a few times here over the past year and then just regain steam once again. So we'll be keeping an eye on the consumer spending data coming out in the coming months and on the labor market to see if this is indeed something that's going to be more of a long-term pivot, or if it's just another instance of the steam engine slowing down for a bit before regaining steam again and carrying on. So there's the consumer spending update. We'll have our eyes on that moving forward.
Thank you, Zach. Well put. And it's hard to believe as we come into this year, just go back a few months ago, it seemed all but clear that recession was on our doorstep back then. All of a sudden to have a massive burst of growth to start out the year. So all eyes on that one. And again, I would say the balance of things, and you and I talked about this on Monday, the balance of things points towards this slowness sticking in a little bit firmer. But as you mentioned, a lot of that will hinge on whether or not the jobs losses continue to mount and we see a reversal in the unemployment cycle. And instead of an unemployment dropping, if it were to rise, that would be ultimately what breaks the back of that spending cycle. So we shall see. And to that point, that is our next point, is a crossover here in labor market activity. Now, one thing, the prior Friday, the Department of Labor released their monthly report on non-farm payrolls. And it showed a still pretty solid addition of jobs in the U.S., like 250,000, adding to what was a very strong January and February. But here's a key point. In the March data, they stopped collecting in the middle of the month. So it takes a couple of weeks to put that together and come up with a report that they file on April. So it's not the full month. And the key there is we had a major shift in the middle of March when we lost Silicon Valley Bank, Signature Bank, and a few others. So what impact that has remains to be seen, and we'll be watching. But we look here at S&P 500 companies, and that can often hold a clue for where things are going. And we see a crossover here. During much of 2021, they dealt with a massive labor shortage, not getting enough workers to hold all the shifts. So the earnings were restrained from that angle. We have seen that slowly alleviated to the point now where job cuts are more and more mentioned. Up to this point, it has largely been technology companies should that spill over, that's what it would take, I think, to create an unemployment cycle that starts to work its way up. So we do seem to have some momentum going that way. Now, again, we have to separate the difference between markets and economies. All this recession talk, we're right back to where we were at the first of the year, where there's so many people anticipating that. It doesn't necessarily mean that the market will have to react, because if so many people are expecting recession, they might just already be positioned for it. So that'll be something that we're parsing through as we go forward, and to see what impact, if any, this mention of job cuts from S&P 500 companies spilled over to the broader economy. Now, shifting over to real estate, another important sector. It's talked about more and more in terms of potential impact on banks. That's to be expected, since we're just coming off of a banking crisis. Everybody wants to look for the next shoe to drop. Commercial real estate inevitably is the next thing to mention. So before we get into the bad news, it's worth mentioning that this current commercial real estate market, while experiencing some pain in terms of price declines, is not over leveraged like it had been in crises in the past. In the early 1990s, the savings and loan industry went under, largely because there was too much borrowed money in the real estate market. And it's a little bit healthier at this point in time. And certainly any real estate investments that we've directed to has a very strong emphasis on having enough equity cushion in the deal that it can survive any drawdowns. And that's what we're going through right now. Not a major surprise given the declines we saw in stocks and bonds last year, starting to filter through into the commercial real estate, which can operate on a little bit of a lag. What's noticeable here, everybody I think understands that office has been really weak as we struggle to have workers come back to the office. Some companies will have a permanently altered work from home policy. Others have tried but failed. So all of that speaks to very high occupancy, very high vacancy in terms of occupancy at office real estate. But joining that is apartments, which have been very strong given how much demand there is for housing, yet we haven't built a whole lot of houses. All of that has spilled towards a very strong apartment, but prices have begun to decline. I would attribute most of this price decline to simply a rise in interest rates, which has impacted valuations of all assets. But that is the factor here, because otherwise the underlying fundamentals are still strong. Rents are holding in there. And again, there's no shortage of people needing an apartment. So occupancy remains very strong, but it's simply that valuation change hitting the prices of apartments, as are, you can see, most commercial property sectors. But office, of course, still out there as the biggest decliner over the past 12 months. Moving on. So over the past year, I would say particularly the past couple of months, and Chat GPT comes to mind as artificial intelligence becomes more and more important, which, by the way, if we haven't mentioned it on the market, Carver, and I can't recall if we did, but Chat GPT gained 100 million users within 2 months. All right, that is eons above any other technology in terms of the speed to reach 100 million users. So that's how quickly artificial intelligence is moving, as many industries are fearing a loss of jobs as artificial intelligence can replace certain fields. Is it going to be lawyers? Is it going to be authors, journalists? And there may be some of that all around. But this example comes to mind when there's a fear of the robot, so to speak, of coming for our jobs. And this is looking at the release of the spreadsheet, which broadcast the imminent decline in jobs for bookkeepers and the like. And that is the purple line. We did see a decline of those roles, but it paved the way for an expansion in jobs and other measures. It opened the door for a management analyst and a job classification that didn't even exist until you could see 1982 there. And the blue line, accountants and auditors also surging. So we see innovation. It's always going to be the boogeyman in terms of coming for jobs, and it will certainly have job shifts, and people that don't adapt will fall behind. But inevitably, innovation is what leads to economic growth and jobs that show up everywhere. So whether or not it may mean that cashiers are replaced with people who write apps for kiosks, as one example, that is the sort of way that we have to view technology. And I think spreadsheets here lays a pretty good example for another prior technology that was coming for white collar jobs, so to speak, that turned out okay for most white collar workers. So that's it in terms of AI and the other 4 points. Zach, thank you for coming aboard. And thank you all of you for giving us a few minutes here of your time for this week's Bark at Carver. And thanks to all of you who came out to see us at this round of third lease. And we'll look forward to seeing you again in the fall. So thank you. Have a great weekend.